You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again at OptionAlpha.com, working every single week to make this the most popular investing podcast offered online because it's based on one thing and one thing only, and that's helping you make smarter trades. So again, thanks so much for tuning in today. On today's show, we are going to be covering just a small sliver of some of the backtesting that we've been doing here at Option Alpha over the last year plus that we're going to be releasing here in the next couple of weeks. Now, I don't have a definitive date yet because I know I get a lot of people who are emailing me lately and asking, like, when's this stuff going to be coming out? But it will be coming out in the next couple of weeks. Believe me, you will know about it. If you're already listening to this podcast and it's been a couple of weeks already, you might want to just check the website and we might have some, news or banners or something on that. But what we're going to be doing is doing a couple things, releasing one completely new backtesting software that you can use. So you'll be able to go in yourself and backtest different option strategy setups and layouts and parameters and all kinds of different things and get performance results for years and years of data on different ETFs and stocks, or summarize all ETFs and summarize all stocks or all trades or all of that stuff. It's going to be ridiculous. And I guarantee that nobody in this industry has what we're going to be rolling out here. And then what we're also going to be doing is publishing a big report on everything, just like what we did with our signals report, but it's going to be a lot bigger as far as scope because there's 21 million different strategies that were tested and then probably billions and billions of trades beyond that. And it's going to be just probably a huge report, but a lot of great information. And we're going to try to break it down into bite-sized chunks so that you guys can understand exactly what we're trying to do here. And when I say 21 million different strategies, that's not a typo. I'm not just, saying that and, saying, it's a lot of strategies. No, it's exactly a little over 21 million different individual strategies that we tested. And so what I mean by a test, just so you guys have some scope and understanding here, and we'll go through this in today's show where we have these 10 back-tested strategies that we're going to go through. But every test is then run on different stocks, different ETFs, different parameters. So a 30-day trade and profit target of 10%, 35-day trade and a profit target of 15%. So all of these little individual parameters are then tested and run on all kinds of options data, which is again, why it just took a little bit of time to actually put this stuff together and then to compile the research and put together a software that allows you to backtest all these parameters yourself. So very excited about it. We'll have more information on that coming out obviously very soon. But in today's show, I want to go through these 10 backtested option strategies that really, again, are a small sliver of what we're doing, but just kind of prove some of the things that we're starting to realize in this backtesting. And one of the things that we definitely are starting to realize in a lot of backtesting is that stop losses do not actually help you become more profitable. And so we're going to really dig down deep into this here today and kind of dispel this stop loss myth, because I think a lot of people like to use stop losses. We'll talk about some of the benefits that we did find in using them, but generally speaking, if you want to generate a lot of return for your portfolio and a lot of income for your portfolio, you're going to want to pretty much nix the idea of using stop losses, at least when it comes to doing some strangles. So again, this is going to be a very small microscopic sliver of what we're doing, but it will definitely be helpful in your trading as we continue to move forward. So in today's show, what we basically did is set up these 10 different strategies using SPY short strangles. And we basically took data for about the last 8 years and did all of these SPY short strangles with different parameters. So we're going to be going over those different parameters, going over all of the return numbers. I promise you it's going to be a lot of information. That's okay. If you need to see a visual of this, we'll have a great little visual chart of all the numbers that we're going to be going over here on the actual show notes page. That's just optionalpha.com/show67. Again, that's just the number 67, optionalpha.com/show67. So again, if you get a little bit lost in the numbers, I understand it's hard probably when you're listening to all these to keep track of everything. We will summarize it all at the end of the podcast, but then post a lot of these numbers on our show notes page so you guys have more of this info and you can kind of dig in and print it out and use it for your own purposes there, obviously. All right, so the first test that we set up was a short strangle in the S&P, and it was a 10-day short strangle. So this is kind of going towards the weekly end of the spectrum. We set up our software and we said, okay, we want an average duration or average days until expiration of about 10 days. So that means that sometimes we could have entered trades 5 days out, sometimes 10 days out. So about a week, a couple days over a week as far as when we were going to get into these trades. The delta on each side was set at 10. So this gives us about a 90 or 80% chance of success again, not including the credit that we received and that bringing it out on either end. So about a 10 delta on each side. And in both cases, in both of these first two cases, we had our profit target set at 50%. So just like what we teach and what we do already, as soon as the trade made 50% profit, so if we took in a $2 credit, if it went down to $1, we'd close it out and bank the dollar, that 50% profit. That was set up on both of these different strategies. So we had that same profit target on both strategies. In all cases here, and I'll just say this again here for this one, but in all cases, we had no IVR filter. So there was absolutely no IVR filter, which means that we just made trade after trade after trade after trade after trade for the entire period. So anytime that we close out a trade, we look to make the next trade. Anytime that we, held on to a trade, if we held on to it for 10 days, we, held on to the next one for 7. We just kept making trade over and over and over again sequentially. Okay. But no IVR filter. So I think that's important because it just increases the number of trades that we did just for the sake of proving the point that we're trying to do here. And it really kind of proves the point. It didn't matter if we did IVR filter. Some of the return numbers are almost exactly the same. If we had an IVR filter in here, the same results could be found with the stop loss or not. Now, in the first case of this pair that we did, these 10-day weekly kind of option strangles in SPY, the only difference that we had, obviously, was that in one case, we tested an exit stop loss at 300% increase in your premium, or 3x increase in your premium. So again, if you took in a premium of $1, then we would only buy it back once it's gone up by 3x, okay? And that was our stop loss. The other strategy that we tested, obviously, was no stop loss. So we said, okay, no matter what happens, if we have a big drawdown, if we don't win on it, whatever the case is, we will have no stop loss whatsoever at the end of this testing period. We just want to go all the way to expiration, win, lose, or draw, or if we hit our profit target, obviously 50% early on, then we'll get out of the trade at 50%. So the results. Here are the results for this weekly strategy strangle that we had. At the end of the entire cycle, your return on doing the short strangle without the stop loss was 6,349%. Your return with the stop loss, so a 3x stop loss, was 4,420%. So almost a 2,000% push in return by not having a stop loss in place. So I'll say that again, because maybe some of your ears are starting to bleed now when you're like, no way that's true. Yes, 100% true. Almost a 2,000% increase in your return by not having a stop loss in place. The win rates for the stop loss trade were 85%, 85.57% on the trades. The win rate for not having a stop loss was actually higher at 88.42%. And look, we know this to be true because what we talk about all the time is that sometimes you'll get challenged on a trade, but half of the time it's going to come back in. So if you get challenged on 10 trades where you start to lose money, half of the time you're going to actually make money because the stock will turn around, reversion to the mean. And so this obviously held true in the case of the actual win rate, 88.42% on the strategy that did not have a stop loss and 85.57% on the strategy that did. Now you had obviously really high win rates in both cases. You had really good profits in both cases, but you did much, much, much better P&L wise and profit wise by not having a stop loss in place. Now, the question that naturally occurs from here is, okay, well, what was the maximum drawdown, right? Because you probably had a bigger drawdown in the case of not having a stop loss. Yes, that is true. Your maximum drawdown when you didn't have a stop loss at any one point was 4.9%. When you did have a stop loss, your maximum drawdown was 4.47%. So when you actually look at the drawdown, there was not, at least on the weekly options, about 10 days on average, there's not a big difference in the drawdown. I mean, 0.5% difference in the drawdown over the course of the entire testing period. And that's mainly because you had a really wide stop loss to begin with. So it kind of let the trade go really, really far against you. And then if it went past that 3x extreme, then you went ahead and you bought it back and closed it out. So maybe you covered, I think in here, you basically got yourself stopped out of 4 trades, but 4 trades on average per year. But those 4 trades on average per year made up a huge difference in your actual P&L over the course of the entire testing period. So again, for the first set that we're testing here, which is these 10-day kind of weekly options and strangles, having no stop loss in place at all was actually much, much more beneficial to your portfolio. All right, so on to the next set of 2 here. And so we did, just so you're kind of seeing here, we did 10 different strategies, and then we did basically 5 sets of 2 so you guys can see these. Now, in this case, what we did is we went out to a 30-day expiration time on average. So again, we're entering these trades about 30 days out. That means that some might have been entered 25, some might have been entered 28, some 32, some 33, but about 30 days on average for entry. And we went to the 15 deltas this time. We still kept the same profit target at 50%, but now what we did is we changed up the stop loss. We said, okay, if we go out a little bit further, and again, we're just testing all kinds of variations here, but we said if we go out a little bit further in time and we now make our stop loss a little bit tighter, what does that do for our P&L? What does that do as far as changing the dynamics of how profitable the trading strategy is? So in this case, our stop loss was set really, really tight at 25%. So if the premium that we collected initially went up by 25%, we're out immediately. Okay, so really tight stop loss. And this is, again, what you see a lot of times. You hear all over the places these really tight stop losses, right? Cut your losers short, let your winners ride. Well, we tested out to see what happened. Now, at the end of this cycle, the trades with no stop loss at all, so the 30-day, 15 delta, taking profits at 50% like always, no stop loss, no IVR filter. That strategy ended up making 3,140% at the end of the cycle. So very, very profitable. When you had a tight stop loss and you cut anything that really went against you more than 25%, your profitability went down to 1,489% over the period. Now, again, that's a 2x difference in profitability because you had a stop loss in place. So no doubt, that means that you were getting cut out of a lot of trades. You still were profitable as an option seller, and that's good, I guess, but you could have been 2x more profitable if you didn't have that stop loss in place. One of the questions that most people ask probably in this case, and I, digging in here, I looked at it really a lot, much closer, is the win rate. So in this case, by having that really tight stop loss in place, that 25% stop loss in place, your win rate was slashed down to 56.71% for this trading strategy. Now, this trading strategy probably starts off as about a 70% chance of success trade. So if you kind of let that strategy go, you should hit about 70% over the course of, time. But by cutting in this stop loss or by adding in this really tight stop loss, you slashed your win rate down to 56.71, which means that anytime that it really just kind of wiggled against you, you're out of the trade and completely, gave up an opportunity to make some money. Now, with the strategy that we did had no stop loss in this case, again, the same 30-day, 15 delta, taking money at 50% of max profit. When you let that strategy go with no stop loss, your win rate was actually 90.40%. Now, first of all, I'm just going to sidebar and say this is exactly what we talk about when we talk about taking winners off early and implied volatility always overstating the expected move, because now we're starting to see that a 70% chance of success trade might actually win out at 90% or 80% over time when you take money off the table early and when you know that you're trading with implied volatility edge in your favor. So that the non-stop loss strategy won at 90.4%. I dramatically outperformed, had a lot of winners just letting it go. So next question is obviously, what's the max drawdown? Well, in this case, you had a big drawdown, obviously, because you let the stop loss or you let the non-stop loss strategy go. And so anything that moved against it in a 30-day cycle was just let to go all the way to expiration. So in this case, your maximum drawdown was 12.96% at any given point. When you had the stop loss in place, because it was a really, really tight stop loss, naturally your drawdown was much less at 5.92%. So you cut your drawdowns by more than half by basically adding in that stop loss, but you also gave up your potential profit by more than half by adding in that stop loss as well. So look, you can then determine what you want to do out of this and, look at it a bunch of different ways and, figure out what's best for your portfolio. But the reality is that if you give yourself a little bit of wiggle room to handle a drawdown and still trade through that drawdown, you still have an opportunity to make a lot more money by not having a stop loss in place. All right, strategy set number 3. Strategy set number 3, we kept a lot of things very similar. We changed up a couple different things. So we're just trying to, again, change up all these different iterations and variations of how we trade these. In strategy set number 3, we did a 30-day expiration cycle, so same as the one before, we now came in a little bit closer and sold a little bit more premium at the 20 deltas on each side. And our profit target was taken a little bit sooner. So we changed our profit target from here from 50% down to 25%. So as soon as we made 25% of our max gain, we were out a little bit sooner because we're coming in and we're taking in a little bit bigger credit. Now, what we did here is we also then kept that same tighter stop loss. So we said, okay, what if we have a tighter stop loss and we have a tighter profit target? Does that change up the dynamics of the trading system, the trading strategy? We take money a little bit sooner, we have a tighter stop loss, or take money a little bit sooner and have no stop loss in place whatsoever. So here's how they performed. The strategy where you had the stop loss at 25%, and again, we're taking profits at 25%, ended up making 760% over the course of the trading period. The strategy where you had no stop loss in place, but you're still taking profits early, ended up generating 1,533% over the course of the period. So once again, your stop loss, even though it was tight and even though you're taking profits tighter, basically cut your return in half by having that stop loss in place and by cutting some of the trades that could have turned around and become winners early. Again, you saw the win rate dramatically decrease in the case of the first stop loss strategy. So taking that stop loss at 25%, your win rate was 66.51% versus when you took profits early and had no stop loss, your win rate was 92.94%. And I think that this is interesting because you actually had a much higher win rate even than the set of strategies before because you're taking money off the table so quickly. Now, you gave up obviously a lot of return for that, but you did have a very high win rate. Now, just like what we saw with the last set of strategies, the maximum drawdown when you had no stop loss was much higher because you're letting the market go against you. In this case, it was 16.66%. That was the maximum drawdown that you experienced in any given time. When you had the stop loss in place, your maximum drawdown was 6.86%. So you still had a little bit of a drawdown, obviously, but because you cut that loss early with that stop loss, you basically capped your maximum drawdown that you would have had in any one given period. Okay. So at the end of the day, again, you're still making this decision. Do I handle a little bit of a drawdown in my account? And believe me, some people can't handle emotionally a 16, 17% drawdown in their account. But if you knew, and hopefully this is the reason I'm doing this podcast, if you knew that handling that 16, 17% drawdown would then eventually lead to a 2x return at the end of the day, maybe you are now having the confidence to actually trade through that situation. All right, so the next set, the set number 4 here of the SPY short strangles, we basically then moved out even further in time. So we went out to the 50-day expiration cycle. So again, we tried to make these trades on average about 50 days out. We did the deltas at 30 on each side, and we reset our profit target at 50%. So now we're back up to our 50% profit target from the credit received. Now, in this case, we set a little bit wider stop loss. It wasn't as tight as the 25. It wasn't as wide as the 300% increase. But we said, okay, let's set a stop loss a little bit wider than 25 because 25 might be too tight. So let's set our stop loss at 75. Okay, so if the premium goes up that we collected by 75%, we're out of the trade. And again, no IVR filter. We just made trades sequentially after sequentially, time and time again. Now, in this case, the strategy that had no stop loss, again, generated 1,042% return over the testing period. The strategy that had a stop loss at 75% generated just 464% over the course of the period. By far, actually, the lowest performing strategy of everything that we tested in this podcast, okay? Now, you still had a pretty decent win rate when you had a little bit wider of a stop loss. Your win rate was 65.91%. That's still decent. That's obviously above 50. When you had no stop loss at all, your win rate was 74.36. Now notice that our win rate from the previous two sets of strategies with no stop loss has gone down from the 90s to the 70s range. And that's okay because we're letting the market move a little bit more to get that profit target that we're trying to shoot for, which is a little bit higher. So we're not taking trades off as early. We're ending up staying in trades just a couple more days, but we end up, making probably about the same or more money than some of the other strategies out there. Okay. So again, no stop loss, ended up winning a little bit more, higher return at the end of the day. If you executed with the stop loss at 75%, you had a much less win rate. It was still higher than 50-50, so you're still better than a day trader or a stock trader, but you definitely gave up a lot of the potential profit at the end of the cycle. As far as drawdowns go, again, you saw a much bigger drawdown when you had no stop loss in place. Your biggest drawdown was 21.99%, so basically 22% at any given period. When you had a stop loss in place and it was a little bit wider at 75% versus 25% in the last two examples, your maximum drawdown was now 13.3%. So obviously, you make that stop loss a little bit wider, you're naturally going to have a little bit bigger maximum drawdown at any given point in the trading cycle. But even in this case, if you can handle a 22% drawdown in your account, believe me, and I know it's tough to handle that. So I'm not like skirting around that issue, but I'm just hopefully showing you that being able to handle a bigger drawdown in any scenario ends up being much, much better for your portfolio at the end of the day. Okay, so those are the two examples here for the set number 4. Now, the last set number 5 here, we did things a little bit different completely. Okay, so we went out 70 days and we went all the way out 70 days on average. So almost 2 months of expiration time. And we did the 30 deltas again, but now we had no profit target at all. So we said, okay, forget taking trades off early. Let's see what happens if we just let trades go and only manage those trades that have a stop loss. So now we really, really try to focus in here on this stop loss, no early profit taking across the board. The exit stop loss was set at 100% or a doubling of the premium that was received. So if the premium received went up by 100%, we set a little bit wider than the previous example, which was 75. And so we kind of wanted to do something in the middle here from our first example and the other ones that we did. So we set at 100% stop loss. Again, no profit taking in this number 5 set of strangles that we did. So here's the numbers that we ended up getting. At the end of the cycle, when you had the stop loss in place, again, set at 100% increase in premium, your return was 1,413%. So actually a pretty decent return. When you had no stop loss in place at all, and again, no profit target in either case, your return was 1,849%. So on a return basis, you generated more money on a return basis, but it was pretty close. It was definitely a lot closer than before. On a win rate basis, the win rate was almost identical in both cases. Now, this is a little bit different because now, again, we're not taking trades off early and managing winners. We're letting the trades go all the way to expiration and basically saying, okay, look, the only time that we'll take this thing off before expiration is if it hits our stop loss. The win rate in both cases was 69.57 or 77%. So within 0.2% difference in win rate, which means you won out about the same amount of time in either case. Now, the difference here is actually a little bit crazy as far as the maximum drawdown. And this was definitely something that we didn't expect, but we double checked and is 100% accurate. And that is that the maximum drawdown when you had the stop loss in this case was 23.69%. When you did not have the stop loss, your maximum drawdown was 14.8%. So in this last and final example, you actually had a much better or lower drawdown when you had no stop loss than if you had one in place. In this case, the stop loss created a lot more drawdowns that lasted for a lot longer period of time. And so that really, really hurt your portfolio because you just had drawdown after drawdown after drawdown versus taking in a big amount of premium and really letting the market kind of work itself out over the 70-day period. And so in this case, it definitely, obviously, the no stop loss one won out, but it was just interesting to see how some of the win rates came a little bit closer together and some of the maximum drawdowns started to flip around. All right, so hopefully you guys have enjoyed that. Let's kind of summarize everything that we went through. I want to kind of hit some major bullet points of everything. Again, I know that was a lot of information. Hopefully it was really helpful to understand, how everything works and what you kind of went through. This is, again, just a very small sliver of some of the backtesting that we've been doing and some of the information and research that we're going to continuously be pumping out very, very soon. And hopefully it was really helpful. If it was, again, please add a review in iTunes for us. Share it online. Help spread the word about what we're trying to do here. So here's some information to kind of, summarize what we had for this set of 10 different backtested strategies. Number one is that you had less trades in every way, shape, or form when you had no stop loss in place. And this is really interesting because, again, what we did is we entered trades sequentially, meaning that we would only enter a new trade once the current trade was closed out or reached expiration. When you had no stop loss, you had less trades in every single case. And in some cases, you had like set number 3, the set of strategies that we tested number 3, you had 170 trades for no stop loss, and you had 215 trades when you had a stop loss. So not only did you make less money in every situation when you had a stop loss, but you also were trading more, which means you're increasing your commissions and whatever ticket charges you have for your brokerage. So having no stop loss in place means actually less trading and more profitability. In almost every case, 4 out of 5 cases, you had a higher drawdown when you had a no stop loss in place. So I don't want to, skirt that issue. I don't want to overshadow it or, try to work around it. No, it's definitely present. When you have no stop loss, you have a higher drawdown, but just realize what you're getting for having a little bit higher drawdown at some period is you're having a much, much higher return at the end of the cycle. Now, the average increase in annual return versus stop loss and no stop loss was 87% across the entire period. So in every situation where we had a stop loss versus none, when you didn't have a stop loss in place, your average annual return was 87% higher. That's a big difference over the course of many years. I mean, you start extrapolating this out over the course of 10, 15, 20 years, and it makes a big difference at your P&L at the end of the day. When you had no stop loss in place, you had a higher win rate in every situation that we tested. And again, this is really insightful because if you're one of those people where you want to win, you have to accept a little bit more risk. You have to let trades go against you a little bit more. And I know that that's a hard concept to grasp, especially if you're new to options trading, but the numbers do not lie here in the sense that in the 10 strategies that we tested here, every single time that we remove the stop loss, we had a much higher win rate. And again, some of these were a big difference of between 56% winners and 90% winners. That's a huge difference in your win rate and your ability to turn over a lot of trades in your account. So again, hopefully this was a really insightful episode for you here on the podcast. If you have any questions or again want to see some graphs and some numbers from the show here, head on over to optionalpha.com/show67. That's just the number 67 at optionalpha.com. And again, be on the lookout for our new backtesting software and report that's going to be coming out in a couple of weeks. Believe me, I will tell everyone about it. You guys will know about it, but it's definitely something that we've been working on for a really long time. I've invested a lot of money personally into this as far as data goes, and I really want to make this something that's beneficial for you guys so that you can start doing all this backtesting yourself and start playing around with these different parameters to figure out what works for your portfolio.
Now, our favorite part of the show, Trader Q&A, where we answer a question from one of our current members about options trading. Got a question you'd like your to answer? Live on air? Just head over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask.
Hey Kirk, Devin Sadler from South Florida. I'm fairly new to options investing and have been putting your trades for the last week or two as part of the Pro membership, which I freaking love. I'm mostly doing everything as an Iron Condor too. When I look at the portfolio beta-weighted analysis, it suggests that I get a decent profit in the middle of the range with break-even at around 201 and 227 on the SPY. I still have substantial tail risk outside of these boundaries, however. Does it make sense to consider buying one SPY call at, say, 220 and then put another SPY put at around 209 to protect against the tail risk? When I simulate it, the maximum profit drops, but I would then have pretty decent profit anywhere along the SPY price curve without using too much capital. Right now, it would cost about $140 for the two puts together. Does this strategy make sense? Or am I missing something? Thanks for your insight and help, Kirk.
Hey, Devin, thanks for submitting the question. And I appreciate definitely the direction that you're going with it, because I think that a lot of people have a very similar question when it comes to beta weighting their portfolio and how to basically deal or manage this tail risk. And so there's a couple things I'll tell you right off the bat. One is that obviously it's all personal. So if you don't think that you can manage or handle that tail risk on a lot of trades over time, then of course doing some sort of protective strategy around your portfolio is going to be good, because then it just minimizes your drawdowns. But also realize that if you do minimize your drawdowns, as we saw in today's basic podcast on all these backtested strategies, which is actually why this kind of fits in really well here, is that when you minimize your drawdowns, you dramatically decrease your chance of success. So yes, will you have some tail risk? Could you be subject to a big drawdown in your account? Sure, you could be, and the market could move really quickly against us. But does that mean that we necessarily have to go out and buy $140 of protection every single month to protect that portfolio? Maybe not, right? Maybe we, do it sparingly when we think that there's a big event happening, like a Brexit or an election or whatever the case is. So I think you have to really ask yourself, if this is the type of thing that you want to do consistently in your portfolio. Now, what I do tell people is that if you are going to, do some sort of tail risk strategy where you go out and you buy protection, just realize that it comes as a cost, right? That insurance cost could be pretty high. In fact, when you look back at show number 63 that we did, which was the 27 different indexes from CBOE, one of the indexes that we covered in that show was the tail risk hedge with the VIX. So it's a different way of going about it, not necessarily buying out of the money options on what you're trading right now, but buying out of the money options on the VIX to kind of simulate this tail risk or hedge risk over time. But again, it really underperformed the market by having to buy this continuous option premium. So my suggestion to anybody who's trading straddles and strangles, so Devin, if this is you, great, you're trading straddles and strangles, just keep the positions small and have some cash left over in your account. Have an account that you can be able to withstand a drawdown if it happens, if the market does go crazy suddenly. We have another flash crash, another black swan event, because we don't know when that's going to happen. Have enough cash that you can trade through that, because as we saw in today's episode and doing all these backtested strategies, if you can trade through that situation and have the consistency and persistence to, basically handle the emotional stress of a drawdown, and you'll end up at a really good position and with a really high return on your money at the end of the day, because you just traded through that situation. So hopefully that offers a little bit of help. I can't tell you exactly if, in your case, buying the protection is worth it or not. I know personally in my case, I would not buy the protection. I would just play the numbers, play the probabilities, and really go for that higher return, higher win rate at the end of the day.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell segment, I actually wanted to cover two quick things. So we'll get into a new trade, but I just wanted to come back and kind of circle back around to one of the initial trades that we did, which was one of our low volatility trading strategies, again, that we mentioned, I believe is back on show 61 with Cameron Skinner. We basically introduced this idea of, starting to do this low volatility trading strategy because of all the backtesting that we've been doing. As you saw in the show, obviously, we're doing a lot of backtesting, and we started to find that when you executed a low volatility premium selling strategy, although you're not going to make a ton of money, you're going to generate a little bit of income for your portfolio, and it helps give you a smooth and stable baseline or foundation for future high volatility situations. So don't get me wrong here. We're not now totally transitioning away from high volatility. We'll still do the bulk of our trading during high volatility, but what we are going to start doing is doing this low volatility, continuous, constant premium selling strategy to give us a little bit of income during these low volatility periods. Now, that trade that we got into initially, I think back on show 61 with Cameron Skinner, was our SPY Iron Condor. Now, we did end up closing out of that trade just yesterday for $171 profit. So again, not a huge profit, but we only did a couple contracts. It was an Iron Condor. We just want to start testing this thing out. And generally speaking, we haven't had a big move in the market. So I can't really say that it's worked well because we just haven't had a big move in the market. But during this time period from that time to now, which has been a little over a month now, we have had a pretty decent stream of these trades come off. And we've made a couple $1,000s on some of these trades that we've done in low volatility. So it's actually been working out fairly well. Now, as far as today goes, we're going to get into a new trade in FXY. Now, the date that I'm recording this show is on September 22nd. Just to full disclosure, we don't always send out the same trades the same day when we do the podcast. I know somebody asked that last time because obviously we want to keep these private for our pro and elite members, but we always will release these out in the future. Still really good to understand kind of the thought process in going into this trade. So today's Thursday, September 22nd. In the case of FXY, we're adding in an iron butterfly for this trade. And I really would actually like to do more of a strangle in FXY, but since this thing has a high stock price, right now it's about $96 in FXY, it doesn't make sense to do the strangle. It's just way too much margin to be able to do this type of trade. So what we're going to do instead is we're going to do an iron butterfly. We're going to sell the 96 call and put, which is pretty much right at the money. And then we're going to go out $4 on either end and buy the 100 call on the top side. And then we're going to go down to the 92 put on the bottom side and buy the 92 put. Now, this combination of buying and selling, or you could think of it as a short straddle with protection, however you want to think about it, is going to give us a net credit of $1.97. Now that basically $2 credit moves our break-even point out $2 on either end. So really what we're looking for is for FXY to trade between about 94 and 98 by October expiration. And so if it does trade between there, or at least between there and now, and implied volatility drops or decays in value that we can get out of this trade, then we'll have a pretty nice profit on our hands. We're going to do a couple of these contracts and try taking a little bit of money, but I think that this trade's a pretty good trade. When you actually look at the break-even points of about 94 and 98, it's about a 60% probability of profit. So it's not an entirely, like it's not a 70, 80% chance of success winner. But what we have learned, obviously, in some of the backtesting is that when we take trades off early, we're going to dramatically increase that win rate by managing this trade a little bit early. In our case, we're going to be shooting for somewhere around a 25 to 30% gain on this. So when the value of the premium goes down by 25 to 30%, we're going to be taking off all the contracts that we have, and we'll try to manage a trade a little bit quicker and take a smaller profit, but then eventually increase our win rate dramatically in trades like this over the course of time. So that's the trade that we're doing here in FXY. It's probably the first set that we'll do. We might actually add a couple more sets here in the future, but we definitely look to make some money here on this FXY trade.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, now I truly hope you enjoyed today's show. And like I always say, hopefully you got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. And as always, you can get additional resources, links mentioned in the show, and some related video training from today's show by going to optionalpha.com/show67. That's just the number 67, optionalpha.com/show67. And of course, if you liked today's show, thought it was really helpful, helped you in any way, shape, or form, please head on over to iTunes or Google or iHeartRadio, whatever you listen to the show on, and please leave us a review and rating. It is honestly the best way to get the show into the hands of those who are just like you, and I would be extremely grateful. Until next time, happy trading.